All right. We have long been waiting to cover Keith Fitzgerald, specifically his emails. So now's a good time to start to roll out our reviews of emails as frequently as possible. So let's jump right in and see if we can really just discover what is the essence, what is the beauty of Keith's logic. Something that a lot of folks subscribe to. I think it's like 40,000 folks that subscribe to his email. But let's dissect the logic, his points that he makes each day, starting with this week, 2nd of July, Tuesday. Let's go right to the email and check it out. So the email starts with, hi, right, good morning. The markets are in a foul mood with all three major indices in the red ahead of the opening bell. So most of his emails start with what's going on pre-market. Keith Fitzgerald wakes up probably around 4 in the morning, it seems, West Coast time. So his first point for Tuesday, the 2nd of July, was that Eurozone inflation had dropped 2.5%, according to the European Union statistics, because Jerome Powell, head of the Federal Reserve, was in Europe this week. So he continues policy wonks the world over watching, because the data certainly suggests that a pause or at least a reduced interest rate outlook would be prudent. The problem is that central bankers aren't exactly known for their management acumen nor strategic prowess. So Keith says, what? My guess is that US Fed Chair Jerome Powell, JPow, will urge caution or play buzzword bingo when he speaks in Portugal later today. Okay, then we will see what the markets make of it. I agree. So his point of view, trying to anticipate the Fed is a fool's errand. The path to profits is clearly defined by what's likely to happen and which companies will get the job done. So focus on that, not what Powell and his cronies might say. Your portfolio, thank you. Yeah, very, very well said. Could not agree more. Keith makes a point of this over and over that following the Fed, monitoring the Fed, anticipating the Fed, front-running the Fed, you're only shooting yourself in the foot because they themselves don't know what's going on. Okay, so the path to profits is clearly defined by what is likely to happen. All right, moving on to point number 2 for his email for Tuesday, the 2nd of July, 2024. Tesla's the most undervalued AI play on the planet. Uncle Elon's Q2 deliveries report is out, and the company beat estimates as price cuts boosted sales. Good. I believe Musk makes a meaningful pivot into AI very shortly, and that this will probably be the last of the bad news for a while. I hope you've been buying. The stock has returned nearly 50% since April, when shares were around $140, and I told you to get on board. It's now trading at $209 and change as I type. To be fair, Tesla is down nearly 40% year to date, but so what? The Tesla stock has returned 1,308% over the past 5 years versus 101% from the SPY. Be in it to win or you won't win. All right, number 3, regarding real estate, New York City's next test. CNBC is reporting that Manhattan is now a buyer's market. The official story is that the high rents have finally brought buyers off the sidelines and that the gap between buyers and sellers is closing. The situation reminds me very much of Japan in the 1990s. The lesson that we learned back then was that you can't give houses away or sell them even as staggeringly low prices if buyers have walked away. That's the real question in my mind. Have buyers walked away, or are they done with Manhattan? Too early to tell. Keith's investing tip. Real estate isn't just about the property or even the income if you're an investor. It's a barometer for everything else in the area. Contrast that with medically related real estate or tech-related real estate, which is still chugging along and in many cases kicks off fabulous income. That's right. REITs are still a great place to invest. New York City housing, that's debatable. How much of a difference does this really make? You tell me. My favorite REIT, according to Keith, Choice, and one of the One Barhead family knows, well, presently sports a 4.51% yield, growing at roughly 6% per annum over the past 5 years. Ka-ching. Now, number 4 for today's email, Tuesday's email. Salesforce comp battle hides a far more serious risk. So this point is actually very, very interesting, and I'll let you know why. So Salesforce shareholders did not approve CEO Marc Benioff's pay package, and in doing so defied a board recommendation. The problem here isn't Benioff or even the pay, though. This started with Musk's pay package battle and the Delaware court that voided the $56 billion comp plan set in place in 2018. So Keith says, I am hard-pressed to think of a more dangerous undercurrent for investors. CEOs could well decide to chuck it or F it if this is the environment they've got to deal with. If that happens, and I'm hearing behind the scenes grumblings about it already, then a slew of currently public companies could go private. Therefore, investing implication. This would reduce the number of quality investments available, further concentrate markets, and increase risk. Talk about being careful what you wish for. Okay, well said. Could not agree more with that fact. When companies are taken private, it takes money off the table. Many negatives outweigh the pros. Okay, so when to say goodbye. His final point for the email. Tuesday, July 2nd, 2024. I'm often asked what to do with XYZ. Usually, folks have purchased something on a whim or as a result of clickbait masquerading as investing research. And usually when the stock in question has lost them a lot of money, facepalm. Okay, my answer is always the same. Mistakes are tuition. So it's important that you don't beat yourself up too badly. We all make them from time to time, including me. What you want to focus on is moving forward. The first question, if you ask yourself, is whether or not the reasons you bought something are still valid. If so, then there is every reason to wait it out. That's why, for example, investing greats Warren Buffett and Ron Barron don't flip from stock to stock, and why I suggest you don't either. The second question to ask yourself is whether there is an alternate investing choice that can help you make up lost ground. If so, can you put that money into another company, fund, or investment that potentially offers a faster path to profitability, more stability, or even the opportunity to reinvest via dividends, which is almost always a great idea? If so, then making a switch could be the better choice. Keep it simple, stupid. Chances are you already know the answer. Bottom line, your mindset can make or break your investment journey. Cultivate optimism, stay positive, and believe in your ability to create wealth. Learn, ask questions, make it happen. You got this. So, great email again from Keith Fitzgerald. Agree with nearly all his points. Looking forward to covering more. These daily emails are truly a lifesaver, and the guy is just overflowing with wisdom and true virtue.